Layoffs are in the news, and today I'm going to explain what that means for you. If you think about this and you look back in history, it's important to address why the layoffs are happening. I'm going to show you the actual data that matters, not the fluff, not the nonsense. You're going to get just what you need to know. The very first thing is those layoffs that are going on in the tech industry, the finance industry, and so many others. The second thing I need to look at is what's next, and of course, explain to you why this is happening. All of that and more. Let's begin. Microsoft to cut thousands of jobs across divisions. Remember that it's not just one type of employee. It's not just the programmers. It's not just the people in the mailroom. This is happening broadly, and you could see thousands of people. In this case for Microsoft, it's 11,000 that they reportedly will be getting rid of after hiring many people. We need to get real with this. I mean, these tech companies had grown tremendously over the past several years, and this is the company that has been around and dominant for decades now. So when they do cut people, it is noteworthy, and understand that 11,000 is a big number. But I wanted to show you this because it's not just tech companies that are doing it. Credit Suisse set to cut 10% of European investment bankers. You look at it, comparing this to others in the space, same situation. Finance, tech, and many others, they've been cutting all over the place. This is dailyjobcuts.com, a website I have shown you many times over and over, and I believe somebody was asking that in the comment section. I do look at every single comment, and somebody was asking about this. I think this is the website you're probably referring to, dailyjobcuts.com, and you could see, among others, Microsoft Corp may cut 5% of the workforce, or about 11,000. You see time and time again what happens when you go into a recession. You have this come up. Now, for so many people, they're unaware of what this really means. Well, you got to first understand where the jobs are being cut from and why. But when you look into it a little deeper, there's always this understanding that the jobs numbers we're being shown, the data that we're being shown, is legitimate to begin with. What if it wasn't? What if it was actually worse than what we were told? Well, then we would get a different view of the economy, and things would actually head downhill as a self-fulfilling prophecy. So it's important for the government to create levels of propaganda that are basically shielding you from knowing the truth. But you tuned into the truth, and so you're going to get that here today. This is just one of many. I mean, I talk about this from many different angles. Here on this channel, I don't just show you the one dimension. You're going to get it from all levels. And this is one. European shadow unemployment is a real dilemma. The latest jobs report in the US shows strengths and weaknesses. And basically they get into it, and I've covered it before, the fact that the numbers don't add up. It depends on the data that you look at. That's really key. When you start to look at instead of the establishment survey, that's what they give you. That's the number. When they give you the jobs numbers, it's called establishment survey. When you see the household survey, it's a different way to measure. Suddenly, it doesn't look so good. What about people that have 2 and 3 jobs? Oh, well, that's another job. But that doesn't account for the unemployed person. What about people that are being hired and fired every single month as temporary jobs? That's a new job added. They don't talk about the jobs lost the month before. No, this is a new job added. So when we start looking at it, there are literally a gap of millions of jobs. Even I believe it was the St. Louis Fed that acknowledged this. They acknowledge that this is happening, but nobody wants to realize that. Okay, look, the latest unemployment figures are very concerning. But what is even more worrying is the analysis of the shadow unemployment. In its latest economic outlook, or Europe 23-24 report, UBS shows the significant difference between the official unemployment in the euro area and the hidden unemployment coming from furloughed jobs and unoccupied workers that do not count as official unemployed. Whoa! You get that? The same scenarios going on in the US and everywhere else. The official unemployment rate in the euro area is still elevated at 6.5%. The highest unemployment rate in Spain is at 12.5, Greece 11.4, Italy is at 7.8. And they do get into more information in here if you want to check it out. Youth unemployment is an extreme problem. But you look at this with the shadow unemployment rate in the euro area is at 8.8%. So these numbers are much larger than what we're being told. And that would be, looking at it, you would say, well, that's kind of like a recession, isn't it? Well, absolutely. But if they tell you that, then you're going to be less likely to spend. You're going to be less likely to go out to the restaurants because you're going to conserve. You're going to try to actually hold your capital inward because tough times are ahead. You want to save for a rainy day, right? Well, you don't want to hear the bad news because, well, then you might not spend up your money and you're a consumer. You got to consume. They want you to consume. And I want to show you something here. You got to know what's next. And let me break it down for you. An increase in layoffs can signal a downturn in the economy. A historical example is the 2008 financial crisis, where widespread layoffs occurred as a result of the collapse of the housing market and the subsequent financial crisis. This had a significant impact on the middle-class families, as many lost their jobs and struggled to find new employment, leading to financial insecurity and hardship. In addition to the immediate financial burden, layoffs can also have long-term effects on individuals and families, such as damage to credit scores and difficulty in finding new employment. It also hit the middle class quite hard. Many of them lost their jobs, homes, and savings. This can lead to increased stress and strain on relationships and overall well-being. Also, layoffs can have a ripple effect on the economy as a whole. When individuals lose their jobs, they have less money to spend, leading to a decrease in consumer spending and potential further job losses. Layoffs can also lead to a decrease in investment and a decrease in economic growth. It is important to note that during a recession, the unemployment rate increases, which in turn reduces the wages and standards of living of those who remain employed. The middle class is hit particularly hard during economic downturns, as they are often the most vulnerable to job loss and have fewer resources to fall back on. They're not the 1%. They're not those who have unlimited resources. So in fact, when you see what's going on with companies like Microsoft, like Credit Suisse, this has a spillover effect into the economy as a whole. Investing in last year's top 10 stocks is a recipe for disaster. You see, you look at this, the changes, increasing interest rates, that has an impact on the stocks. So you might say, who cares? I don't care about stocks. But if the stocks start going down, the companies lay people off. You see how it works? I'm bringing you back to the beginning. People don't have the attention span to last this long. They don't get it. And of course, they remain financially illiterate. You could see the top 10 performing stocks in the S&P 500 in 2022. Occidental Petroleum, Warren Buffett loves this, has a huge stake in this company. Going down the list, you could see names you may recognize, such as ExxonMobil. You hear all of the names out there. What are the most famous? Oh, yes, that's right. It's Amazon, it's Tesla, it's all of the fan favorites from the retail crowd. But if you see what actually did perform well, many people didn't own any of it. And they're saying, do not do what you did before, because we're in a different world. We're in a different market today. Stocks have come off their bottom. That's very important. I highlighted this previously. If you're paying attention to the channel, I said on multiple occasions in September and October that it looked like October would be the bottom, at least in this term right here. Who knows what happens down in the future for the stock market. And it looks like that has been the case. The S&P 500, I believe, is a few hundred points up higher than where it was when I made those posts. So here we are today looking at that. What are they worried about? What are they trying to get at? Well, if you can see it, it's basically suggesting that the inflation rate is peaking. Their market's trying to get ahead of that. And the expectation is that in 2023, the Federal Reserve will definitely stop increasing interest rates. And there's actually potential for cutting interest rates. That would be fantastic for the markets and risk assets because, of course, they rely on this nonsense. And so here we are today. I broke that all down. If you're watching each and every video, you saw that coming and hopefully you took advantage of some of that. Big banks might face breakup according to top regulator. This is really important because the banks are getting bigger and we could see that they're just really conglomerates because one buys the other out over time. And usually that happens during a major crisis. You can look at this and say that, not really going to affect me for one reason or another, but I would have to extend this out into what's going on with the tech industry. They've been lobbying the government to make sure that they don't have any worry for regulation because, just look at the financial markets. I should say the financial companies. These financial companies it's obvious that they didn't have much regulation because look at what happened during 2008. But you look at what's going on with tech stocks. They have even, a fraction of the level of regulation. So what happens with these companies will have an impact on the tech industry because it's just from one to the next. So watch that very closely because I know a lot of people are way, way overweight on tech stocks. In fact, many people only own tech stocks, which is extremely dangerous. BlackRock's Larry Fink warns of substantial impact from markets on earnings. This is going to be, I'll show you a few of these actual earnings situations, concerns coming from a lot of different people. Earnings are the big thing, okay? And if the earnings don't stay buoyant, if they're not really doing well, that will bring the stocks down as a result. First signs of recession pain look set to emerge from earnings. Again, here we go. Whether it's coming from one sector or another, we're seeing it all over the place. And why? We got to know why. It's higher interest rates slows everything down. Increased interest rates because of inflation, okay? Because that starts to pick up. Wages are increasing. They don't like that, of course. They want you to stay poor. You look at what's going on with, all the prices that we paid for everything from our energy to food to housing and so on. They want to make sure that that goes down. And so you got to increase interest rates. When you increase interest rates, you make it more borrowing more difficult, more expensive. As a result, companies feel the effects of this indirectly and directly. They start to lay people off. Shopper rebellion against higher prices helps slow inflation. Companies are hitting the brakes on price increases after wary customers limit their buying. They want to save money and raising prices is not an option. So here we are headed towards the peak. Some places it doesn't seem like that. I see lineups out the door at some locations, but it depends how affluent the areas are. But in general, this is what's happening. Companies are trying to liquidate what they have. Lululemon, Walmart, Target, many other retailers doing the same thing. So watch that very carefully because it's going to have an impact on their company as a whole. Okay. And then just showing us about, this is from Bank of America, just explaining the fact that what we have today is very different because of what the Federal Reserve does. And they have a balance sheet that we've never seen anything like this before. So the effects of it, we don't know. They're trying to wind down that balance sheet and they're going to struggle doing that because there is no other buyer. They are the buyer of last resort. And so that presents itself with a huge issue, massive, absolutely massive. And you could look at it coming in the effects of manufacturing index. This is the U.S. Empire State Manufacturing Survey, just going at the levels we haven't, this is the same level back in 2008. So we know that the economy is really doing poorly right now today. It comes up in many different stats, but that's just one of them. Look at the data, look at the information, and you decide what you want to do. You can make those choices. I just bring you the information you need to know. Did you find it informative? Well, right down below this is a subscribe button. If you hit that, it's right next to the like button right down there. Each and every day I'm going to bring you the latest and greatest information. I don't get into the fluff, no bias, no nonsense. You get only the greatest stuff to watch each and every day. I'll see you tomorrow. Take care.